So at the outset, I just want to thank the entire Taxmann team for giving me this opportunity and inviting me to share my thoughts on this very interesting topic in the real estate sector. This particular sector has been little complicated since the inception of the tax regime itself on it. It got started from the levy of state on the works contract, and then it became further aggravated when service tax was introduced on a works contract services. While the GST, when it came in from 1st July 2017 onwards, the entire sort of state levies on works contract vis-a-vis service tax, everything got merged to GST. However, the issues around this are still some issues remain unresolved on this particular sector. And large chunk of issues in the real estate sector surrounds around this unique concept called joint development agreement. So what we are going to do in this entire webinar for next 45 to 50 minutes, we are going to talk about the basic concepts of a joint development agreement. What are the construct of joint development agreement, parties involved, transactions involved? Is it sort of valid to sort of tax this particular transaction? Is there any legal jurisprudence around that? And also talk about certain practical issues which have been faced by the industry so far on while implementing this particular entire scheme of legislation with regard to the joint development agreement. Yep. So while as I mentioned, this industry is being perceived as being complex in nature, but I'll try my level best to put forward these entire implications in the most simplistic manner as possible. Yep. So moving on, let's first of all understand what is a joint development agreement. So as the name suggests that it is joint is there. So obviously there are two parties involved, one being the landowner and two being the developer. Landowner is the one who is sort of the owner and of the land parcel, what he's having with him. And the developer is the one who has expertise to construct the particular buildings, etc. on the land. Both parties becomes interested, and the arrangement between them is called joint development agreement, where essentially what happens is the landowner allows or give permission to the developer to enter his particular land. Uh, he also allows the developer to sort of construct, take necessary approvals for construction, construct the superstructure on it, to own the superstructure which is constructed on the land, and eventually it can be sold to the third party buyers by the sort of powers which are being generally granted as part of JDA and the other documents which are executed as part of the joint development agreement. And eventually, consequently, the parties agree that whether either the landowner will eventually get the certain portion of area out of the constructed property, or it can also get the particular revenue share out of the particular constructed area or whenever it is sold by developer. For each sale, he can get a agreed portion of revenue also. That's called revenue share arrangement. And the previous one is called area share arrangement in JDA. And why JDAs are sort of predominantly very popular being in this industry, because of multiple reasons. Few of them could be the land ceiling laws are being prevalent there. Uh, the parties can leverage the expertise available with one each other surrounding this particular arrangement. Also, it also helps both the parties to have better commercial exploitation and sort of commercial benefit arising from the same land, as compared to if the land is sold as is, vis-a-vis the land is sort of developed and both the parties are eventually benefiting out of it. So because of multiple reasons, JDA is one of the predominant and prevalent mode of arrangement in this sector, which sort of has its own issues and pros and cons, which will come to it as we go further. So now maybe we'll move on to what are the important documents in the entire framework of joint development agreement. It starts with JDA, as I mentioned, that is a critical document which essentially lays down the role and responsibilities of parties, which lays down the agreed ratio in which the parties intend to sort of whatever is the outcome of it, either revenue or area, they sort of agree on it in the particular agreed ratio in the joint development agreement. Then comes a general power of attorney, which is essentially a document which confers sort of powers to the developer by which he can take requisite approvals from all the relevant authority. He can also eventually, after construction, the superstructure also, he can convey it to third-party buyer because of the powers given generally in a typical GPA. Then there comes allocation agreement, which sort of, because at the time of JDA, the only ratio is agreed generally, but the area or the specific units are identified subsequently. And at that point in time, allocation agreement is being entered into when the sort of entire layout is being finalized and specific units attributable to specific people are being identified in by way of this agreement. Then there comes commencement agreement, which when sort of the entire project gets commenced uh, by the authority, the commencement certificate is issued by the authorities and the developer commences the work by way of excavation and everything, which is commencement or date of the particular project. And then at the end, after all the sort of development, at the end, when the project is completed, the competent authority issues a certificate of completion for the project. Some states, they also issue occupancy certificate as well. That's the sort of guardrail when the development or the project is being completed. Any sale happens post the completion will not be subject to any GST. So this sort of completion certificate milestone is very essential. Now, when we've understood the sort of JDA as a concept and the documentation, it is sort of crucial to understand what are the different milestones in a JDA arrangement. We'll only talk about key milestones because which are relevant for us in the future discussion as to which sort of sale price to be factored and which sale price will be relevant to determine we'll talk about various transactions, which sale price sort of becomes crucial here. As we spoke, the entire journey starts with executing the JDA and the other documentation. Then after the JDA is entered into, the first sale happens by the developer to any third-party customer, which is called a sale nearest to the joint development agreement or nearest to the date where the development rights are transferred by the landowner to developer. This sort of date is quite relevant and critical because we will see that the transactions are valued depending upon this particular rate. For the ease of convenience, we'll refer this rate as either the first sale value or the launch price for the ease of convenience. But this is something that the project is being sold to a third-party customer nearest to the JDA date. Thereafter, multiple subsequent sales happens to the customers, uh, which is there and then could be at different prices. Then eventually the sort of sale happens just before the completion certificate is about to come. That is called sale, which is closest to the date of occupancy certificate or completion certificate. This also, the sale price is quite crucial. As we go along, we'll get to know the importance of it. For the ease of convenience, we'll refer this price as maybe the last sale value uh, before completion. So this also is crucial. And then completion comes, and after completion certificate, the handover and the conveyance, the actual possession is being transferred to third-party customers or the landowner, as the case may be. Now, sort of it's crucial to understand what are the different supplies or transactions involved in a joint development agreement. As we mentioned that there are two parties, landowner and the developer. The landowner is the one who transfers the development rights to developer, and developer in turn transfers or provides construction of the units which pertains to landowner to them. And the third transaction happens is the developer, whatever is the area allocated to developer, he can sell it to third party customer. That is number three. And number four, the landowner can also sell the units, whatever is allocated to him, to the third party buyers. So essentially, there are four transactions which we can see on the screen. There are different suppliers, different recipient of service. For TDR, very important to understand, landowner is a supplier, the recipient is the promoter who is sort of getting the development rights and constructing on that particular land by way of getting the development rights. Second transaction of the service of construction, the promoter is providing the service of construction in return of the development rights what he received from landowner. And third and fourth transaction are simple because those are being sold to third party customers. So these are the four transactions. We'll get into the GST implications for each of the transactions. But before that, it is crucial to understand that the law has evolved over the time period with regard to the entire real estate sector, or be it JDA also, the law has sort of, we can see there are 4 different milestones we can see on the screen. There was a pre-2012 era when service tax was only applicable on specified services. Then post 2012 to 2017, there was a negative list regime in service tax where certain activity was specified in negative list on which there was no service tax was leviable. Then 1st July 2017, the major change happened. GST came in and the entire law got changed. And then eventually in April 19 is the major milestone in this entire scheme of real estate or a joint development agreement, in which the sort of multiple notifications were issued and a lot of new concepts, new terminology were inserted in the legislation. Why those are crucial to understand here? Because as we know that these sort of real estate or joint development agreements sometimes are spread over multiple years. This could be 5 years, 10 years also. So it's very critical to understand in what sort of, when the supply got crystallized and which relevant law at the time of happening the transaction should be sort of levied on this particular activity. And hence it's crucial to understand at which sort of part of milestones or governing principles we are staying in. Now, let's come to the major part. We talk about the first transaction in a joint development agreement, which is transfer of development rights, right? Transfer of development rights has a major shift or major distinction between, if we see the service tax regime applicability vis-a-vis the goods and service tax applicability on this particular TDR supply. In service tax, what was excluded from the levy of service tax was transfer in title of goods or immobile property. And as we know that the definition of immobile property is quite wide, which also includes the benefits arising out of land. And TDR as a concept is nothing but profit pendor in nature, which is the benefit arising out of land, because as a landowner, he separates development rights from the land and give it to the developer or the promoter to exploit the particular rights and construct a commercial complex or residential complex on the particular area. So it's nothing but benefit arising out of land is being transferred to someone. Will it qualify as immobile property and will be excluded? Yes, there were multiple judgments in service tax regime which sort of seconded the view that TDR is nothing but a transfer of title in immobile property and hence should be excluded from the levy. We can see the multiple precedents on the screen. And hence law was sort of to some extent settled because of the judicial precedents available. But when GST came in, there was a paradigmic shift under the charging section and the exclusion from the levy section itself. What was excluded from the levy of GST is only the sale of land and sale of completed building and not immobile property. Whether can we say that the TDR constitutes sale of land itself? This was something which was tested recently by a developer called Prahita Construction before Telangana High Court, where Telangana High Court categorically dismissed the writ petition, holding that TDR does not qualify to be sale of land because it does not confer any ownership rights to the developer. The developer only becomes the owner of proportionate superstructure only after satisfaction of multiple conditions. This matter is currently pending at Supreme Court. So far, even there are some advance ruling under GST, which also seconds the view that TDR is taxable under GST as service transaction. So far, I mean, till the time Supreme Court ruling comes and the issue attains finality, taking a view that TDR is not taxable under GST is little quite aggressive in nature. And in the entire discussion on the webinar, what will not go to the legality of the entire scheme, which has come in 2019. Rather, we'll talk about the implication of the scheme if we apply the scheme as is to the particular facts of the case. And the legality is something which can be also, I mean, only challenged, and when the court sort of comes back, strike of levy, then only it will be relevant to reassess the particular implications. We discussed about the attributes of development rights, what it is all about. So now, as I mentioned, that there was a paradigmic shift of the levy of real estate sector all on the JDA in 2019 with effect from April 1, 2019. The large sort of discussion of this webinar will be revolving around the new notifications, new scheme of legislation came after April 19, because now as we're standing in 2024, the previous or the transition period has slightly gone away already, the issues we have seen through. It's more important to understand the new framework right now. So the 2019 notifications has introduced the certain new terms, new terminology in the entire framework. As we can see on the screen, they added a new term called promoter, project, real estate project, residential real estate project. A lot of these definitions were referred to a legislation called Real Estate Regulation and Development Act 2016. So RERA was referred for all these definitions, which sort of the ultimate theme coming out of this particular new sort of scheme of notification is they are clearly distinguishing the projects which are for the purpose of selling to third-party customers, either entirety or even a portion of the project. So wherever there's an intent of sale of the project and wherever there's no intent of sale, because there are multiple projects which are constructed with an intent to lease to the third-party buyer subsequently and earn from the leasing income and not from the upfront sale of the particular projects. Those sort of projects, it appears that will not fall under the revised scheme of notification because the project is defined clearly and even the promoter is defined clearly who construct the project, which should be only for the purpose of either selling the entire or even the partial units of it. When there is no intent to sell, a zero unit is being sold at the beginning of the project and there is no intention at all. Essentially, RERA approval also is generally not taken by the developers and they do not qualify to be promoter as well, as we see the definition, because the project is not for the purpose of selling. Why these definitions are important? Because they are, as I mentioned, distinguishing the project which are for the sale. And because of that, the JDA arrangements have been sort of largely divided into multiple buckets. As we can see on the screen, there could be projects which are intended for sale, for which you might take a RERA approval or registration. Then there could be a projects which are not intended for sale. Those are for the leasing purposes or subsequent people may retain for their own use or any other purposes. In that also there are different combinations. It could be either residential project, which is called a residential real estate project, RREP. It could be either a commercial project. And then the ultimate arrangement between the parties could be either area share or revenue share between the landowner and developer. Similarly, when the projects are not intended for sale or rather for lease, it could be largely commercial because we have practically very limited or very rare scenario. We see that there's a residential project which are not sort of constructed with the purpose of selling. Largely real estate project are or the residential project are being constructed with the intent of selling at least some part of the unit. So those will qualify in the first bucket of the entire chart is there on the screen. But the commercial, largely we are seeing that the developers are sort of not upfront selling the constructed units. They are keeping it with themselves for the purpose of leasing out to the tenants. And why this segregation is important? Because the taxability differs for the each type of project, which will go one by one coming to it. So we'll start with the residential project, which are intended for sale to the buyers. And first we'll talk about the area share project. So let's take a simple example that there's a project happening. Eventually on the land, there'll be 100 units being constructed. 60 units will belong to the promoter. 40 units will belong to the landowner of the entire constructed portion. The first and the foremost transaction in the joint development agreement is transfer of development rights. We'll have to crucially examine each and every sort of aspect to it. Who is the supplier of service? As we saw in the previous slide, that development rights are transferred by the landowner to the developer and not vice versa. So supplier of service is very clear. In the general scheme of legislation, the sort of tax is being paid by the supplier of service in any indirect tax framework. However, for the development rights, there's a specific provision under the reverse charge notification being inserted that any person who supplies development rights to a promoter, the liability or the onus to pay GST was shifted with effect from 1st April 2019 on the promoter. So here, the person liable to pay tax will be promoter here and not the landowner, even if he's the supplier of this particular service of development rights. Then the next question comes as to when to pay this GST. Because if we go by the normal logic of time of supply, it says when the date of supply of service or date of receipt of consideration, whichever is earlier, has to be paid. But here for TDR, by invoking the special powers to the government under section 148, they issued a notification called 6/19 with effect from 1st April 2019 to defer this particular time of supply, saying that the promoter can pay a reverse charge in a tax period not later than any tax period in which the date of completion or occupancy is issued. So essentially, as we saw the timeline chart in the previous slide, the liability will be paid at the time of completion of the project. Then comes the question that on what value the promoter has to pay under reverse charge. It's fine, the promoter has to pay, he has to pay to the date of OC, but what value? So they have given a deeming fiction to derive at the value here, that it will be deemed to be the equal of value of similar apartments which have been charged by the promoter from independent buyers which are nearest to the date of the transfer of development rights. So we saw in the first slide of pricing that the first sale value of the property to third party buyer will be considered for the purpose of computation of the deeming value of TDR. And there is also an exemption being granted from the value, that whatever value is being derived for development rights, only the proportionate value which is for the unbooked portion on the date of completion only will be subject to GST. So the exemption is clearly granted for the booked units up to completion. Essentially, the entire theme, what they are trying to create is on each unit, it should suffer tax once. So when the developer is selling to third-party customers, in our example, 60/40, 60 units are being sold by developer to third-party customers, they'll have to charge GST to them. On 40 units, we'll come to it in the next transaction, that developer has to charge GST to landowner as service of construction. So, and all the units are being suffering GST at once, and hence whatever units remain unsold on the date of completion, in that proportion, the TDR liability will have to be paid. Remaining will be exempt from GST, and there is also upper capping to this particular exemption for the payment of liability, rather that this liability, whatever is coming as proportionate to unsold portion, considering the first sale value at 18%, cannot be higher than had the GST being paid on these units on the date of completion, charging 5% rate. So basically 5% GST on the unbooked portion, valuing at the date of completion value, the GST cannot exceed on TDR between 1 and 2 options. We'll come to it with some examples, so it will be more clearer. But just taking through the basics of provisions, maybe a little bit more quicker, so that we have enough time to discuss about the practical issues and the examples and certain scenarios around it. Again, coming to the rate of tax, it is 18%, which is being given under 11/17 notification. We'll come to it, why it is 18, why there's no land abatement. We'll come to it subsequently. And ITC, whether the input tax rate will be eligible to the promoter, the answer is no, because the entire scheme applicable after 1/4/19 is with the condition that on residential apartment, there'll be no GST input available to the promoter. So this is the first transaction of transfer of development rights. The second transaction in this entire scheme of barter, because landowner is transferring something and getting something in return, both the parties. So it's a barter sort of a transaction. Second transaction, as we spoke, is the provision of construction service by developer to landowner. Here, there is no reverse charge. So as per the normal scheme, promoter will be liable to pay GST. Again, the time of supply, just like TDR, they have deferred to the date of completion certificate. up to that date, they can charge GST. There was some anomaly earlier that it was till that on the date of completion, which they have rectified subsequently in June 2021 to make it tax period not later than the completion, so that the landowner can effectively take the credit of whatever GST is being charged by the uh, promoter. Value of supply, again, this was deemed uh, as the value charged from the third party customers. But here, the change from the previous slide, what we saw for TDR is they have given abatement of the value of transfer of land, because had the unit being sold to third party customers, it is being sold, total amount charged to third party buyers are for two things. One, for the constructed property. Two, the undivided share of land which goes around along with the property constructed. So that abatement has been granted here, which is as per para 2 of the notifications, which prescribes the deeming fiction of 1/3 of the total amount charged will be the deemed value of the land. Then there are the rate of tax on the construction service, which is given by notification 11/17, which is 1.5% or 7.5% effectively. Uh, so while in a general parlance, what we see the industry sort of put the land abatement in the tax rate itself and talks about the effective rate applying the land abatement to the rate of tax. But the framework of legislation does not grant any abatement as such in the rate of tax. Rather, the abatement is given in the value of the supply. So that is why the value will be done 2/3 will value will be taxable, but the rate we should consider as more of the gross rate applicable when we look at it more like an academically or technically. And ITC, yes, ITC to the promoter, as we mentioned, will not be eligible to be taken on any construction cost. But the landowner as a party can take the GST input tax credit of whatever the promoter is charging to them on this particular element of construction service. So as I mentioned earlier, effectively 60 units what developer retains when he sells, GST is being charged. 40 units what it transfers to the landowner, the GST is being discharged by way of this particular transaction. So the entire theme is that all the units are suffering GST once, and if the entire units are being sold before completion, the entire liability on TDR would be exempt from GST. The third transaction is the sale of units by the promoter, either the promoter or the landowner to the customer. So the third and fourth transactions, which will be essentially similar to as we saw for the transaction when the promoter was giving the units constructed to the landowner. The only change here is there's no deeming fiction in the value. The value will be the actual transaction value because the parties are not related parties. So the actual value charged between the parties will be the transaction value here, and the remaining implications remain similar. So far, we have spoken about the implications of an area share JDA in residential, which are intended for sale to a buyer. What is the major change if we talk about revenue share? The only change happens is when it is a revenue share JDA, the parties or the landowner is receiving revenue from the sale of each unit instead of receiving a specific set of units constructed. So the major change between area share and revenue share is there is no transaction number 2 here. There is no provision of construction service by the developer to the landowner here because they are receiving the monetary consideration in exchange of giving the development rights to the promoter, and hence the transaction number 2 implications will not arise. And the second major change happens between area share and revenue share in a residential JDA is that because in a area share, you are the landowner is effectively getting certain area, which there was a deeming fiction is being given how to value it. In revenue share, the landowner is receiving actual monetary consideration. So by logic, there was no need to prescribe a deeming valuation because the consideration received by the landowner is clearly in monetary terms. So by logic, they have not defined any deeming fiction for a revenue share JDA. So whatever is the actual revenue, what the landowner receives from the developer out of the sale of units will be subject to GST here, and will be the value of TDR other, and it will be exempted to the proportion of booked units till the date of completion certificate. Here, one more point to note here is that the units which are sold till completion, the landowner will get his share of revenue. But whatever units are not sold till the date of completion, will have to estimate the revenue which could accrue to the landowner, and hence the gross value of development rights would be total, and not only the value unit which is sold to the particular third-party buyers. So this is a major change between area and revenue when we talk about residential JDA. Now let's sort of deliberate about the common issues or the routine issues which we see practically being faced by multiple developers and landowners in a residential JDA, which are meant for selling to third-party buyers. The first and foremost basic issue comes whether is we spoke about whether TDR can I avail a land abatement for the value of TDR or not. The question comes because as we see on the screen, there's a distinction being made by the deeming fiction. When we talk about the value of TDR, the para 1A is giving the deeming fiction in notification, which says value of similar apartments near to the date of JDA, it has to be valued. Whatever the landowner is receiving for giving development rights, you have to value basis the first sale value, right? And there nothing is mentioned about the land deduction at all. However, the value of similar apartments when sold to third-party buyer will also include the land value. So that is very much clear. Vis-a-vis, if we see the valuation of construction service as part of para 2A of notification 11/17, they have been clearly saying, okay, the similar total amount charged to third-party buyer, but the value of transfer of land, the deeming fiction of 1/3 value, will be reduced from the value of service of construction. So the moot question arises when the entire transaction is barter in nature, then can there be a different value? Because here, let's say the first sale value is 1 crore rupees per unit. For the inner example, 40 units belong to landowner. The value of TDR will be 40 crores. Vis-a-vis or the GST payable on TDR value will be 40 crores into 18%. Here it will be 40 crores into 2/3 into the applicable rate, depending on affordable, non-affordable. So is this justified to give a concessional value of one transaction in the barter, where the eventually the when the computation is being happening, the value is computed considering the land value also. So this is one of the question or moot question arising on that. There's some clarity by of FAQ which came in May 2019, which sort of says that the TDR will be taxable at a gross rate of 18%. So even on the rate side of it, which is generally used as common parlance, the abatement, there is no effective rate of 12% by 1/3 abatement. It's 18% gross rate is being clarified. And one can also argue that from a department perspective that this calculation of TDR is being calculated depending upon the value of units. That does not mean that this value includes land itself. Only the valuation methodology has been given as 1A, but not that it has been sort of derived basis the particular value of units. So going by that logic, it might be contended that the TDR would be leviable to GST 18% on the entire value, including the land. So on this issue, what we are seeing practically is a lot of developers have been sort of, because of the anomaly in being there and deeming fiction being there clearly in the legislation, not allowing the any abatement. Practically, a lot of developers on the ground level has been discharging GST at the rate of 18% on the gross value without any land abatement on TDR. But there's a scope of this being challenged because of the sort of maybe violation of rights here on the sort of injustice being caused because of the distinction being created. Moving on to the second particular issue here, which is being faced, which has been sort of very commonly faced. As in an example, let's talk about the project has 100 units, 40 belongs to landowner, 60 belongs to developer. Out of 40 of landowner, 30 is being sold, and there are 10 unsold units, which landowner intends to retain with himself. Out of developers unit, 20 are being unsold and 40 are being sold to third-party buyers. As we saw that for computation of exemption or the taxable value on the TDR, it will be taxable in the proportion of unsold unit on the completion. The question comes, the unsold unit will include for the entire project, or it will be only unsold units in the hands of developer. And this issue is why it is arising because the formula which is there on the screen, which is given to arrive at the GST payable on TDR, it says that the the carpet area of residential apartment in the project, while it should have been mentioned as in the project or in the hands of developer in the project. That could have been removed the anomaly in the legislation, but so far the formula is being there. We are being seeing practical challenges uh, from department side on ground that they have been alleging that even the landowners unsold units should be factored for arriving at the TDR computation. In our considered view, that should not be the sort of practice. Why? Because the entire theme of this entire scheme is that the unit should suffer GST once. On the entire 40 units, as we spoke, right, the developer or the promoter is discharging GST on construction service, and the landowner is receiving GST invoice from the promoter for all the 40 units. Out of that, if landowner is selling 30 units, he can take input with a proportion to 30 units and collect GST from the buyer. For the unsold 10 units, GST is already paid by developer. The only thing is, if it is not sold before completion, the GST will be a loss in the hands of landowner. He'll not be able to take the credit of it because those are not being sold. So effectively, GST is being paid. Had the formula taken in its literal interpretation, could arise to a situation that GST will be paid twice on these 10 units, which are unsold in the hands of landowner. So on this issue, what we are seeing practically is the sort of position has been unanimously similar, largely being settled that the unsold units in the hands of developer is being factored. And practically, we have been seeing developers taking indemnity from the landowner in case of any future disputes which could arise uh, uh, since the landowner is sort of intending to retain certain units and not selling further to the customer. Moving on to the third interesting issue in this sector, which dwells deeper to the non-refundable deposit at its how the implications arises. Typically, what happens is the landowner essentially to protect its rights and also maybe to have some working capital cash flow in its hands. When the JDA is entered into, there are two kinds of deposit landowners receive from developer. One which is a non-refundable deposit. Two is refundable deposit. Refundable deposit is very much clear in the definition of consideration. It will not fall because it's refundable in nature unless it is applied against a consideration of a supply. It will not be GST leviable. The question comes for non-refundable deposit, that how non-refundable deposit has to be factored in this entire framework of levy. So here we'll have to see that the computation of GST on TDR, so there were two formulas. One formula was given as first proviso to entry number 41A, and second is second proviso. First proviso clearly says that on the total gross value of GST on TDR, we'll apply the carpet area ratio of unsold to total. So on the GST payable on TDR, it has to be computed because as a landowner is receiving two consideration. One, the constructed units in return plus non-refundable deposits. So the value of development rights is total of monetary plus non-monetary. On that, 18% is applied. by that the first computation comes. Here, NFD or the NRD is being considered in the gross value to apply the 18% rate. Second computation, it clearly says that whatever amount comes in the first proviso, it will not exceed 1% or 5%, depending upon affordable, non-affordable, on the unsold units if you value it at the date of completion. So when we apply a rate of, let's say, 5% or rate, taking the OC date value, the tax will not arise. So this is a deeming fiction itself in its nature, which does not sort of factor about the non-refundable deposit in nature. So hence, there's a clear distinction between the first computation and second computation. Second being in nature talks about the maximum cap of the liability. So a reasonable view can be taken that while computing clause B, which is the upper capping under second proviso to this entry 41A, uh, only the unsold units will be valued at the gross rate of on the date of completion, and any non-refundable deposits received may not be factored here. But obviously, there could be litigation around it, but given the scheme of legislation, we feel that should be defendable. Uh, Next issue comes around the cancellation of units. Many times what we see practically that the OC comes, let's say in an example here, on the date of OC, the developer had 40 units sold and 20 as unsold. 3 months later on, what happened is, or maybe a few months later, before the actual possession, there is a certain cancellation happens. And there is a circular 188 given in issued in 2022 that the customer can take a refund if there is a subsequent cancellation of a project beyond the timelines of issuance of credit note by the developer. So let's say some cancellation happens after the date of OC, but before the final possession, uh, 5 units got unsold in an example here on the screen. As promoter, when he's computing his liability on TDR on the unsold portion, how many units he should factor? 40 or sorry, 20 or 25? So here, I mean, going literally by the legislation, it says, if you see the entry here on the screen, on the date of issuance of completion certificate or the first occupation, which was earlier. So literally going, the promoter has to factor the units on the date of completion. However, the entire scheme, sort of the entire theme will fail because these entire 5 units, if it is sold subsequently, there'll be no GST charge on it because the completion certificate has come, and hence those should be factored as unsold for this computation. So here, more of a pragmatic view should be taken rather than more a literal interpretation because of the entire sort of intent of this scheme on this issue. Uh, Next issue comes surrounding the valuation of unsold units in JDA, which I think we have largely spoken about in the previous slides. So in the paucity of time, I'll skip this issue. And the another issue comes interesting is we have seen that the landowner can avail the ITC when the promoter sort of gives the unit to him. There are transactions we have seen practically that the landowner is effectively selling back the units to developer for some commercial reasons. It could be any reason. Landowner, after getting his 40 units, let's say 10 units, they sell it back to developer. The question comes whether the developer can take input of it or not, because developer will be further selling those units onward to customer. There is no restriction in 17.5, but if you apply the rate of 5% or 1%, which is with the condition that the ITC is not eligible. So this sort of going by the literal interpretation, ITC is not eligible. So here, the alternate structure should be evaluated more to sort of avoid when this transaction happens, to avoid the loss of ITC in the hands of developer. We can explore some other alternate structures here. Quickly moving on, seeing the paucity of time to the commercial joint development agreements. In commercial developments, as we saw for residential, the major change is that there is no exemption being granted on the development rights. The entire development rights are being taxable, but the benefit given in commercial is that the promoter can take ITC of the entire cost of construction or whatever he pay under reverse charge on the development rights. As long as he's selling the units further to the end customers, he can take the input off. So one benefit and one loss, no exemption, but ITC is eligible. That's the major difference when we see commercial vis-a-vis residential JDA area share in the hands of promoter. And the one change is there is no sort of abated rate of 1 or 5% here. It's a 18% rate, which if you apply the abatement on the rate comes to 12%. And when we talk about the major difference between residential revenue share vis-a-vis commercial revenue share, the major difference here is on the time of supply. That the notification 6/19 defers the time of supply for commercial residential revenue share JDAs, but the same deferment is not available for commercial revenue share JDAs. So if the landowner receives any monetary consideration as part of transfer development rights, those will be taxable at the normal time of supply provisions. Now, maybe we'll just jump to some practical issues in commercial JDAs. What happens commercial JDAs is because the developer can take input credit. The question arises that, and they also take abatement of land while supplying the units to end third-party customers or the landowners. 1/3 abatement in the value is being taken. Practically, we have seen authorities disputing and issuing notices to the developer, seeking the reversal of ITC because the value of land, 1/3 abatement which has been taken on the value, considering that to be exempt supply. And under section 17, subsection 3, and the sort of ground from the authority is that the developer should apply that sort of ratio of exempt to total to taxable turnover on the common credits and hence seek the reversal. Here, if we see the legislation in more granular detailed way, 17.2 read with 17.3 only prescribes sale of land for the purpose of reversal. Here, can we really say that developer is supplying land to the landowner or the third-party buyers? The answer in our view should be no, because it should be only the UDS being supplied to third-party buyers. Landowner is only keeping the ownership rights. So as far as supply from developer to landowner is concerned, there is no supply of land. So while the abatement value is being given, however, there is no sort of exemption being taken on the value. This is further supported by the fact that generally this sort of common credit reversal arises when there is a concessional rate of tax is being given in notification. And para 4 or the expression 4 notification gives that whenever there is a concessional rate given with some conditions, you have to reverse ITC on common credits. However, here there is no abatement given on the rate as we spoke about. It's only on the value. So while these are being there on the ground, we are seeing litigation around it. But if it reaches further, we believe that at the higher forum, this should not be sustainable. And one can reasonably take a view. And the next issue, maybe we'll just take 2 more minutes on this, is then whether can, as we talk about that, the promoter has to pay GST under reverse charge on the development rights. And the time of supply is on the rate of completion. So promoter, the output supplies to the promoter or GST is arising, liabilities arising as and when he's selling the unit to the customers, he's receiving consideration and the output liability is getting generated. On TDR, if he paid GST at the end of the completion of the project, essentially what will happen is he's eligible to take credit, but how will he utilize the credit? Because the entire liability got paid before completion itself, assuming, let's say, all units are being sold to the customer. So here, can the developer pay proportionate amount of GST on TDR as far as the output liability is concerned, just to match and reconcile that? Or he has, if he takes a position that, okay, if he wants to, because the notification is saying not later than the OC date. If I opt that option that I want to pay, let's say, before the completion date, do I need to pay on the entire value of TDR, or can I pay on the portion of the value of TDR? Because if I pay on the entire value, there could be again practical problems to the developer. if liability is being discharged and whether it is really required as per the legislation. So here also we have been seeing little disputes around in this industry. Uh, a view could be taken that while the developer may be allowed to discharge the GST liability on TDR in a phased manner, but there has to be reasonable basis how that particular liability is being arrived to, basis the milestones or uh, the progression as per the contract, and not maybe on an ad hoc basis. And then there are issues in non-RERA projects, or rather the projects where there is no intent to sell. Because the entire scheme of the notification came in 2019 applies when the project is intended for sale. Can the project really, or can we really apply the entire scheme of 2019 notifications, which are largely for RERA projects or where the projects are for sale, to the projects, commercial projects largely where the intent is to lease, right? So those issues are there. First and foremost issue comes, who is the person who is liable to pay tax? Because if you see the reverse charge entry, which is there, it says any person who transfer development rights to a promoter, the promoter is liable to pay tax. So the emphasis is on the word promoter. And can we really say that the developer in a commercial project which is not meant for sale uh, qualifies to be a promoter, which is defined in RERA section 2 ZK? It may not be. So if it does not, then the basic rule of GST will apply. The supplier of service being landowner will be liable to pay GST here on the transfer development rights. Again, the next issue comes on what date the timing has to be paid, because 6/90 notifications, which defers the time of supply, is also referring that the project which are meant for sale. So can we apply the similar analogy, and the liability of the development rights can be deferred to the date of completion, or it will only crystallized on the date of transfer itself? Here there are different divergent views being there, and one has to take a call basis the underlying joint development agreement and what sort of terms and conditions being prescribed there. Accordingly, the view should be taken. And again, the value also, whether one can apply the deeming fiction, deeming value being given in the notification on this also, especially when there is no sale happening here. And the entire deemed valuation is based on the sale to a third party customer, either near to the completion or near to the transfer of development rights. When there is no real sale happening, what is the alternate available? Whether one has to go to the valuation rules and arrive the value in a sequential manner from Rule 27 to Rule 30 or 31, or he can arrive at the alternate valuations of guideline value of the land, or he can apply cost per 10%, is sort of needs to be seen here, and which is sort of there are different views being taken by, because of the absence of clarity in the entire scheme of legislation for these set of projects. What we've done, we have summarized the GST implications for each of the project, each of the variant of the project here in this slide, which we have discussed in detail earlier. The next important issue which we want to touch upon is the additional floor space index or transferable development rights. So transferable development rights is distinct from transfer of development rights. The essential difference between the two is when we talk about transfer of development rights, so far what we're talking about is it is in a JDA arrangement where the landowner is allowing the developer to enter his premise and construct or develop the building on its land. That is a transfer of development rights, which is not a certificate as such. It's just a permission given by way of arrangement to the developer. Whereas TDR or transferable development rights or FSI uh, is rather a certificate which is granted by the governmental authority when someone either surrenders the land for public purposes or some other reasons. These are being granted by the development, by the government, which sort of essentially helps a promoter either to use himself, or it can be sold to a third party buyers, and that those sort of builders or promoters can use or can load these TDRs in their project to construct multiple floors of course, subject to the development control regulations. But these FSI can be used for construction of multiple floors in excess of the allowance limit. So these TDR are more of certificates or scripts, whether these are taxable in the first place. So the intent of registration, the scheme, everywhere the law has termed FSI along with the transfer of development rights in a similar fashion. And even the FAQ clarifies that GST is leviable on TDR or FSI also at the rate of 18%. And hence the intent is very clear of government by sort of scheme of notification and clarifications that even TDR or the additional FSI also is taxable. There are multiple issues in the context of FSI, which maybe we'll come to questions first, Q&A, if there are anything, and then we'll come to this if time permits. Okay. Yeah, so I'll just go to questions one by one. Practically, okay, if the development is happening in phases, then conditions are to be looked separately. So the scheme, Harish, is clarified in the way that it has to be seen at a project level. So if even if development is happening in phases, if the license of RERA is taken for a project, the implication will arise at a project level, even if the project might have multiple buildings, but the conditions have to be looked at the project level, not at the phase level in a project. Practically, have you seen? Yeah, this has been already answered. Now coming to Q&A session. Yeah. In an example where 60 units are for builder and 40 units are for the landowner, the land to the extent of 60 units will also be transferred, for which the 40 units are consideration. On this argument, will there be GST? Well, this is the crucial argument which has been taken in the recent petition which is filed before Prahita Construction before Telangana High Court, that there is eventually a transfer of UDS or the land essentially for at least the portion of development area share. But court has rejected that argument that there will be still GST because that ownership is transferred to the promoter or the developer only on completion of certain various condition precedents. This does not arise. Let's say there's a cancellation before maybe starting construction or of in the partial construction. Eventually, the ownership rests with the landowner only. The ownership of developer only arises when the superstructure is being constructed, and hence this has been already sort of tackled by the High Court. Let's see what Supreme Court takes a view on it. Yeah. Redevelopment scheme will answer your question separately, Siddhant. I mean, this was more about a JDA for the first development. Construction of commercial project on a leased land. Uh, there is no distinction being given whether land is freehold land or leased land. The implications would be largely similar. Rather, on the leased land also, whatever lease premium is being paid, the implication of reverse charge and on the date of completion will arise similarly. Yeah. ITC available. Okay. Rajeshji, yeah, so ITC is available when the commercial project is intended for sale, even if it is on the leased land also. But if the commercial project is intended for lease to the subsequent buyers, that is again subject to Safari DT's judgment, which is pending before Supreme Court, whether the ITC can be taken or not taken. How can you sell on leased land? So this is sort of happening practically in, especially let's say in Noida, the ownership land is generally with the governmental authority. They are only granted on a leasehold basis for a long-term lease. So all constructions happens on the leased land, and there's a general sort of settled principle in various jurisdictions on income tax also that the constructed property on the land can be seen separately from the land itself, and hence the sale of superstructure can be separately being done on the leased land also. Hope that answers your question, Rajeshji. Yeah, with this, Nishal and Shiva, we have answered the question. Thank you so much, everyone, for joining this webinar and taking time for this. And uh, so lastly, what I just wanted to conclude the session by saying that while JDA has its own implications and pros and cons, we have also been seeing practically that the developers are being exploring alternate structures as well, which sort of arrives or achieves the similar commercial objectives, but maybe a little bit more cost efficient in terms of the entire scheme which we've spoken about. And it's been interesting. While we could not cover some of the issues due to time, maybe we'll circulate this particular slide deck to you via Taxmann. And if you have any questions, my details are there on the screen. We can reach out for further deliberation discussions. And as I mentioned, these issues are quite debatable in nature and contested in nature, where even the judiciary cannot decide the single view. So whatever we mentioned in the entire discussion and deliberations were sort of my personal views on this entire scheme or the issues which sort of could have diversity and divergent view could be possible, which I'm open to discussion, open to debate, and we can discuss in a more closed manner. Thank you so much. Thanks for it.